Hello, this is Brian Lysing with Financial Brokerage, and in today's video I'd like to explain how you can calculate a historically based guarantee on a protection-focused IUL. Now, why is this a big deal? Well, life insurance companies have been pushing this product type for years as an alternative to GUL. It's even more important now as more and more companies have either raised prices on new GULs or have dropped the product completely. Now, why is that? Well, in our current extended low interest rate environment, it's just not profitable. Companies have to reserve a lot of money for GULs. That money's tied up long term at extremely low interest rates. It doesn't make sense to tie up those dollars for that long. That means your go-to GUL might not exist any longer. If it does, the pricing's much higher than what your clients enjoyed in the past. If you haven't educated yourself or illustrated PIULs in the past, you may be forced to do that very soon. Now, this video will help you understand how they work, why you want to use one, and how to explain a historical guarantee to your clients. Instead of relying on a secondary guarantee to keep a policy in force, like we're used to in a GUL, a protection IUL relies on the cash value in the policy to keep it in force. That sounds a lot like the first generation of ULs back in the 1980s. Those relied on fixed interest rates. Now, these are a little different. We're dealing with index products now. We're going to use several decades of history to determine the returns we might expect. Now, this is the primary concern people have about this product. We're relying on the illustrated rates to keep the policy in force. Will those current illustrated rates of 5 or 6% really happen every year? And what happens in a down market when the policy earns 0? Well, that guaranteed column on the ledger showing 0% shows my client's policy lapsing in their mid-80s. I don't want to show them that. But if you've said that, I don't blame you. But ask yourself, how likely is that scenario going to happen? The guaranteed column assumes the maximum costs of insurance from day one, which we already know is not how the policy is being issued. It also assumes a 0% interest rate forever. With an index, that means the stock market would have to be negative or level for the remainder of your client's lifetime. On the illustrations, that means the next 30 to 40 years or more. Now, how realistic is that? Has that ever happened in our history? Exactly how close have we come? Well, that brings me to a historically based guarantee. If you really want to illustrate a historically accurate worst-case scenario, you can't use 0% interest for multiple decades because that has never happened. What should you use? Well, here's a couple of options your clients might understand. One of our partner companies conducted this very analysis and looked at the worst 30-year time period in S&P 500 history, 1928 to 1957. What happened in this time period? The Great Depression. Things were bad, but during that time, the S&P 500 actually had a total return of 2.8%. Not bad. But we have an index product. We don't participate in the market losses. What happens if we don't have to make up for those losses? What if we had a protection-focused IUL back then with a modest 9% cap? Well, that would have produced a positive 4.5% rate of return. Certainly not the current illustrated rates around 6%, but far from the 0% in the guaranteed column. Here's another what if. What if you think that time period is too far back in history? What would a more recent recession look like? Well, we were able to calculate a more recent recession, one that your clients still probably remember, from 2000 to 2009. We get not one, but two market crashes, 2001 and 2008 in that time period. Now, the S&P actually had a negative average annual return during that time, negative 1%. What would that look like with an index cap of 9%? It's a little lower than our Depression era scenario, as you might expect. We're now at 4.17%. Not much of a drop. So now you have two numbers you could use. Maybe even round down to an even 4% to be really safe. But certainly using a 0% return as a worst case scenario is not remotely close to being historically accurate. If you want to give your clients a guarantee, run your illustration solves at one of these historically based 4-point-something interest rates. What will that look like? Well, I can't guarantee it will work every time, but the vast majority of the time, you can get your PIUL to historically guarantee to greater than life expectancy, maybe age 90, for much less than the current lowest priced GUL on the market. That gives you options to bring permanent life insurance pricing into your client's affordable range, or conversely, increase the amount of coverage you can provide for their family. I hope that helps you understand more about how these products work. The industry has been trending towards these for a few years now, and we've recently experienced an acceleration towards these products and away from guarantees. You need to make sure that you're keeping up. So let us know how we can continue to help you help your clients.